There are two challenges that traders typically face with liquidity. The first is knowing which level is actually being targeted, and the second is knowing whether the price is going to make a continuation or a reversal, which involves an understanding and advanced market structure, which most traders lack. So in this video, we've broken down everything you need to know about trading liquidity into 5 simple steps. So let's waste no time and start with step number 1, which is understanding the different forms of liquidity. Liquidity refers to areas in the chart that either contain a large quantity of unfilled orders or a large quantity of stop losses, and it presents itself in 2 different forms. When people typically talk about liquidity, they are usually referring to the external range liquidity, ERL, which can be either a previous swing high or a previous swing low. These are pivotal moments in the chart because they either result in a trend continuation or a trend reversal in the form of liquidity runs and liquidity sweeps, which we will be covering further into the video. The other form of liquidity is internal range liquidity, which is just another name for fair value gaps, FVGs. This is what the price uses as fuel to attack the swing highs and lows. It's important that you pay attention to how the price interacts with both forms of liquidity, because together they will tell you which direction the market is going to move. For our next step, we need to talk about order flow and how it can help us determine which liquidity level we should be targeting. When we look at a chart, the first thing we should do is look to see whether the current order flow is bullish or bearish. And this depends on whether the price is pushing through buy-side or sell-side liquidity, which can seem confusing at a glance. But we can simplify this through the use of 2 concepts, which are called break of structure, BOS, and change of character, CHOCH. So let's see how they work. When a new swing forms on the chart, liquidity levels are created at the swing high and swing low. The liquidity level at the high is called the buy-side liquidity, and the liquidity level at the low is called the sell-side liquidity. For the context of break of structure and change of character, we look at which type of liquidity was ran through when this new swing was created, which in this case was a buy-side liquidity, which means we are currently in a bullish order flow. So with this in mind, our current break of structure level is the buy-side liquidity. This is because a break of structure refers to the level that would need to be broken through in order for the current market trend to continue, which in this case is an uptrend. And on the other hand, the current change of character level would be the sell-side liquidity. And this is because if this lower level was to be hit, it signals to us that the order flow might be looking to change, which in this case would be from a bullish order flow to a bearish order flow. But this leaves the question, how do we know when the order flow has reversed? Well, here we have another uptrend, validated by the break of structure. Let's say price has hit resistance here, but this time, instead of creating a higher low, we instead see price push down to form a lower low. This is what we call a change of character, because it is the first signal that the price action may be changing from bullish to bearish. When this occurs, this lower low becomes the new break of structure, and the previous swing high now becomes the change of character level. This is because this high is now the level that would have to break in order to signal that we could be returning back to bullish order flow. But as it stands, we shouldn't flip our bias to bearish just yet. And the reason being is that this change of character could really just be a liquidity sweep. Instead, we want to wait to see if the price will push down and pass the break of structure level, as this will confirm the start of a downtrend. So in summary, a break of structure BOS confirms a trend continuation, and a change of character signals that the direction of the order flow could be reversing. We'll now develop what we've covered so far in our next step, which is understanding the relationship between external ERL and internal range liquidity, IRL. Here we have an uptrend, and we know this because the price has created a break of structure by pushing through the previous swing high. And with this new bullish swing that was created, we have our current external range liquidity, ERL levels. But because we know this structure is currently in an uptrend, we should be expecting the price to target the upper buy-side liquidity level. But in order to do this, it needs to find some kind of support that can create the next bullish leg. And this is where we look within the previous swing for bullish internal range liquidity, IRL, in the form of a bullish fair value gap, FVG. And this is what the market can use as fuel to go and push through the buy-side external range liquidity, ERL. So what we've just seen happen is the market has used internal range liquidity, IRL, to push through the external range liquidity, ERL level. and this has now given us a new swing with its own external range liquidity levels. So to summarize this, during an uptrend, we expect to see the impulsive moves leave behind internal range liquidity, IRL, in the form of bullish fair value gaps, FVGs, that can then be used in the future to push through the buy-side external range liquidity to create new higher highs. And for downtrends, it's the same, but just in reverse. If we are expecting price to break through the sell-side external range liquidity, ERL levels, we want to look within the previous impulsive bearish move for internal range liquidity, IRL. They can progress to move lower in the form of a bearish fair value gap, FVG. So now it's time for the next step, which involves understanding the difference between liquidity runs and liquidity sweeps, and more importantly, how we can predict which of the two is going to happen. When the price attacks an external range liquidity level, which is either a previous swing high or a previous swing low, it can do one of two things. The first option is for it to continue in the same direction, which is what we call a liquidity run. And the second option is to create a reversal, which is what we call a liquidity sweep. This might seem simple at a first glance, but understanding what price is going to do at a liquidity level is where most traders struggle. So let's start by looking at liquidity runs first. Here we have a swing high, which is the current external range liquidity that we are drawing into. Price then pushes up and closes above the level. But as it stands, this isn't yet a liquidity run. It has only created a breakout. What we are looking for is an additional bullish candle to form that creates a bullish fair value gap, FVG, that overlaps with the breakout of the external range liquidity. This is because in order for the bullish move to continue, it needs to create internal range liquidity, which it can use as support during the next retracement. On the other hand, if it were to create the fair value gap, FVG, above the level, this is also valid. The important part is that the internal range liquidity is created during or after the breakout because this shows strength for the buyers by creating an area that they can use as support for the next leg up. However, if the fair value gap was created before the breakout, we cannot use it for validation of a run on liquidity. We have to wait and see if the chart creates the correct internal range liquidity that favors a trend continuation. As for liquidity runs on the sell side, we use the exact same principles, just upside down. This means we are looking for the creation of a fair value gap. This is the typical setup that we tend to see when the market creates a liquidity sweep. And the important note to take here is that we shouldn't actually be taking trades solely on how the price reacts to the external range liquidity. Instead, we should be looking at how the market structure forms and then look for entries when it has shown a clear directional bias, which moves us on to the next step, which is that we should be using top-down analysis when looking for our trade setups. We'll demonstrate this by analyzing this segment of a chart on the 4-hour time frame. So firstly, we want to know which direction the current order flow is moving in, which we can see is bullish because we have this break of structure through the previous buy-side liquidity. So this means we should be looking to buy from somewhere within this range. But where exactly should we be looking for our trade entry? Well, going back to what we covered earlier about the relationship between external and internal range liquidity, we should be looking for a fair value gap, FVG, within this leg that we can use for our long trade. But even with this, we shouldn't just blindly take a trade if the price draws into it. What we should instead do is move down into a smaller time frame to analyze whether the market actually respects this 4-hour fair value gap, FVG. So here we are looking at the same chart, but now on the 15-minute time frame. And as expected, we can see the current order flow on this time frame is bearish, which we can confirm with this break of structure. But remember, we want to enter a long trade. So what we are looking for is a reversal on this 15-minute time frame, so it aligns with the bullish 4-hour order flow. And when we mark out the current external range levels, we see a sweep occur. When a reversal like this occurs, the first fair value gap to form afterwards. The key takeaway here is that we should always analyze what the market is doing on the largest time frames first, because this will give us an idea of how we can expect the price to behave when it hits an area of liquidity on the lower time frames. If you found this video helpful, please leave a like and then comment what trading concept you'd like to see us cover next.